What's up, Barry Source Nation? I'm here again with our good friend Barry Habib, the Oracle, the man, the myth, the legend. Needs no introduction, so let's get right into it, because if you're like me and you're watching all this craziness in the world, you're probably scratching your head a little bit because, man, I'm seeing some crazy stuff happen, yet the stock market is just going crazy. So Barry, first of all, thank you for being here, but I'm going to stump you right out of the gate because I got the hardest math equation ever, and I'm not even sure you can solve it. So you ready?
I'm ready.
You ready? Okay, tell me how massive unemployment plus corporate bankruptcies plus worldwide protest and looting and a pandemic all equals stock market rally, like record highs. I don't get it, man, so I had to call you, and you took our call, so I appreciate it. But help us solve that math equation, man, because I don't get it.
Well, you know what I said in the update the other day, right? You were saying this right before we went on. You know what I said in our morning update the other day? Kind of experience tapped me on the shoulder, right?
Experience is tapping on the shoulder, telling me like something strange is afoot at the Circle K.
Yeah, because what I said exactly was that, you know, when everyone is on the same side of the trade, it typically goes the other way. And I think what I mentioned almost verbatim in the update the other morning was, you know, when you see everybody get on CNBC and talk about, oh, yeah, we're, you know, this got nowhere to go but up, this and that, and everybody's bullish. And we watch sentiment indicators, and even amongst investors, sentiment had reached extremely high levels. Everybody's bullish. You really have to be careful during those times. And sentiment is a really good contrarian indicator. I've learned that a long time. So I watched everybody talk about how great the stock market was. And sure enough, 2 days ago in the update, the exact words I used was, you know, experiences tapped me on the shoulder here and saying that we're probably headed lower in the stock market, and we think that rates will do a lot better because of it. And I think we called exactly where we would go on the 10-year Treasury, and sure enough, we're there. Although almost every expert said we're going higher, we're going above 1%. But it's good to see that the old reliable indicators still work. So to answer your question, you know, we have seen this before. We've seen it, and you and I talked about this with previous crashes, that you get this move higher. And if it's okay with you, I want to just share my screen for a minute here, because I want to show you where we are in the current environment. So let's take a look first. So we're going to take this step by step. And let's start, since we're talking about the stock market, let's start with the stock market, then we'll go to interest rates. You can see very big down day in the S&P, 128 points. The Dow's down, as we're speaking here, 1,300 points. So where do we go from here?
I guess your experience was right. I mean, just a couple days later, there was a retraction.
Here's where we were here. The world was all bullish. Everybody was happy. And we said, you know what? It just doesn't feel good to us. And sure enough, we've seen the big move lower. Now, where do we go from here? You see this blue line, that's the 200-day moving average. It's my opinion we're going to test that 200-day moving average. Now, the exact level, and just to kind of clean it up for you, I'll get rid of the 25 and the 100-day moving averages. That's about 3012. So I think we head in that direction. Maybe it's not exact. Maybe it gets to about 3,000 on the S&P, maybe 3010. And I think you'll probably see some buying come in here. And it's really important to see if it does or if it doesn't, because you can kind of eye this and you'll see that we've got this uptrend going, right? You see this uptrend, and oh, look at where we are. Isn't it interesting? Where we are right now is, you just draw the line and it kind of comes to where we are today. This is what every computer is doing. And as they draw these trend lines, computers will probably do some buying at this level. So I think that today's slide may be halted a little bit here, but it might drop down towards the 200-day moving average. We're seeing this is an area you should see some buying come in. So most of the damage, at least temporarily, will be done. But a break under this level, a break underneath the 200-day moving average, and I think we start to head down towards this 50-day moving average. You'll probably see some lower levels if we break that. If it does hit here, we could probably see a bounce. But, you know, things you have to be careful of, and you know I like history. The move that we have seen, which is just a dramatic move from this low point right here to where we are right now, this is a little above 47%, between 47 and 48%. And, you know, let's go way back in time. The 1929 crash looks eerily similar. Big move up, huge crash, and then from the low point to the high point, I know it says 50%, it was exactly 48%. It was a 48% move. We're at 47.5% now. 48% move. And then what happened? The big downturn. Okay, so notice it doesn't go in a straight line because it doesn't look like much, but it reached a low level, and then you had some buying come in, but then it persisted. Then some buying comes in. It does not. It never moves in a straight line. It does look like it's a straight line here, but there are periods in time. Everybody says, "Oh no, the worst is over. It's all good. It's all good." And you get the fear of missing out, and then all of a sudden we get a big down. Let's just buy some. Then a big drop. Oh no, the bottom is here. Oh, here's where the bottom is. Here's where the bottom is. Here's where the bottom is. Here's where the bottom is.
Right.
Before you know it, you've lost 90% of your money from the top.
Yeah.
Okay, now I'm not saying that this is going to happen. All I'm saying is I'm a student of history.
Yeah.
And I was not convinced because this does not make sense to me. Look, we saw the numbers from the Fed. We know that we're going to be persistently high in unemployment. This reflects 3.5% unemployment rate. We're not at 3.5% unemployment.
Right.
We are getting very expensive at earnings. Yes, there's been a lot of stimulus. Yes, that does help. But look around, everyone. Just look around. One of the greatest investment minds of all time that I love, and nobody talks about him enough, is Peter Lynch. He's a hero for me. Because what did he do? Well, he only was the best fund manager in history. Crushes anything Warren Buffett ever did, or all these people look at. If you look at Peter Lynch, what he did was he just made decisions based on common sense. He'd go to the shopping mall and see where there are lines out the door. That's the company I'm buying.
Yep.
His wife said she really liked these legs pantyhose and said that, I can't believe it. It's better than any pantyhose I've ever gotten, and it's cheaper, and it's this and that. So he investigated the company. He made 11 times his money on that investment. So if you just look at the Peter Lynch philosophy, which is what I really try to always do, is what if we come back 90%? Will this economy be rip-roaring at 90% of what it was? Even in the best case, what the Fed is predicting 2 years from now, we get to 6% unemployment, still double what we were. Does this justify the same levels in the stock market where we were? Because that's where we were in February. Here's where we were in February. Here's where we were here. And by the way, in our update, we called this exact level here. Take a look at this. In our update, we said this window right here, we said, this seems like a level to us that looks like a top. But I also said, and you heard me say this in the interview that I had Katie Stockton on,
Yep.
I said, maybe it doesn't reach all the way to there because people aren't going to wait for the credits to roll. We've already seen this movie before. We know what happens. So I am skeptical. I have been skeptical of the stock market's rally. So when you say, does it make sense? I don't think it makes sense. I don't think it's justified. But as John Maynard Keynes said, the market can remain irrational longer than you and I can remain solvent.
Yeah,
so
great point.
Have been wrong before. Lots of experts have been wrong. What I'm telling you is that I think that there is reason for caution. I had David Rosenberg on a really good call, and what he says, sometimes you just wait to see that a bottom is really put in.
I remember him saying that.
We give up a couple of points. So what I'm saying to you is this does not make sense to me. I do not buy all of the hype, all of the bullishness that's out there. I think people generally talk their book. And I would just proceed with a little bit of caution. That's all. I think that some caution, it will be rewarded. And if you take a look at what the Fed's trying to do and what even the Fed has said, and they've usually been errant on the bullish side, that usually comes in worse than what they've thought. Even their estimates paint a picture that is hard to justify these levels of bullishness in the stock market. Now, I could be wrong, bro. I could be wrong. Who knows? But we got to be careful. Now, meanwhile, let's take a look at the bond markets. Let's first start with the 10-year Treasury. And, I'm very proud of this one. We just said here, when everybody else in the world was saying lock, rates go, we said no. We said, hold on. We think that we're seeing a little bit of what we called a rollover here. We saw negative stochastic crossover. And I called this exact level, said it's going to come right to the 50-day moving average. I was here. Sure enough, it looked like it was going to be a long way off. We're at 91 basis points, and nobody believed that we'd hit 68 basis points on the 10-year. But sure enough, we're dead on it right now. So the next steps that we have to watch out for are, do we break this level? There's a lot of room to the downside if we do, like a lot of room to the downside. You're probably looking at somewhere in the neighborhood of 55 basis points is a real tough area to break, but we could break it. It could go lower. If the stock market does start to really sell off, money's going to come into the bond market. And here, let's take a look at mortgage bonds. We've had some wonderful gains, right? I mean, From this bottom here, which we pointed out this pattern, this is usually a bottoming pattern. In Japanese candlesticks, it's called a hammer. And when you take a look at that, look at the gains that we have had since then. I mean, it's a gain from 102.92 to 104.31. Now it's 140 basis points that we've gained. It's 3/8 in rate, 140 basis in 1, 2, 3, 4 days. Look at the tremendous reward. I want to show you this chart because it shows our history of being able to call this stuff. Notice we did not do a rate lock alert for 2020 from December of 2019 until March 9th of 2020. Here's our first rate lock alert. Think about this. That's why I love when people say, "Oh, I take every loan, I lock it." Are you kidding me? You destroyed your pipeline. You destroyed your relationship with your realtor. You destroyed your relationship with your customer because you probably lost a ton of loans. You destroyed your company because you had to do 100 pricing exceptions. Just watch what the market is telling you and then understand where the right times to lock in are. And you'll be able to see that these are the exact times because the market gives you the data from time to time of exact periods of time when to do this. And we are right now approaching a level that I think we've got a little more room to go. Let me show you where I think we could go. I think that it's quite possible we get up a little bit more to this 104.15 area, to 104.45 area, about 30 basis points more. Now, again, maybe not in a straight line. If the stock market continues to sell off, I think we've got a little bit more room there. And then you've got some highs that it's going to be a little bit difficult for us to kind of break through, at least in the short term, unless we get some help from the stock market. But we're in very good shape right now, interest rate wise, right?
So can you slide that graph to 6 months on the bottom there? Because that's kind of my follow-up question. So in short, guys, too early to tell if we can really claim the V-shaped recovery. I love the history lesson because I personally think that that's entirely possible. But as Barry said, hey, maybe the V-shaped recovery holds. It's too early to say. I personally don't buy it, but that's why I want to reference.
Yeah, bro, I don't buy it for the economy, and the stock market has done this before. And let's remember what so many of my very wise mentors have always taught me is that the stock market is not necessarily a good indicator of what is going on. And you know what, bro? I'm just from the heart here. It's like I was like almost embarrassed with what the stock market was doing with everything that was going on. It was like no show of sympathy, no show of
completely disconnected.
Like it made it like almost where you were like embarrassed to see that, even greater distinction of, wealth gap and things of that nature, because everybody else is hurting and the stock market's doing this. I mean, it was almost disrespectful,
Yeah. This is kind of leads into my next question. So can you pull that graph back up for 6 months? So mortgage originators totally understand what I'm about to say. Some realtors do, but you can see that erratic behavior there in the middle. And that was before the Fed stepped in. Barry is very instrumental in helping us. But you can see when the Fed stepped in. Without their help, without the manipulation, right now it's about $4.5 billion. Is that right, Barry, as far as Fed help?
Yeah, so what happened here was that this is where we saw the big sell-off in the bond market, and it only came because stocks sold off so precipitously that when the stock market sold off, it created margin calls in the stock market, and people had to liquidate good assets like bonds and gold. So the bond market got here. The Fed panics here and says, we better do something. So they break out the bazooka and they buy $250 billion in 2 weeks, closed all the margin calls. Here's what we got in front of them over this weekend. This is the 27th of March, the 30th. And since then, I mean, you can see since that period of time, look what's happened.
I mean, you can draw a straight line. It's calmed way down. So the principle was some outside influence. The Fed came in, right? We can see it. Like it absolutely calmed everything down. It actually helped the mortgage industry.
By the way, Rob, what they did is they took their foot off the gas here a little bit. They just started buying, just the right amount. Here was too much. This was kind of the Goldilocks amount.
But it makes you wonder, if you and the Fed didn't listen and didn't get involved, where would the mortgage-backed security market be? I would assume probably not as steady as it is today. So I guess my question is the same principle applies in the stock market. It's completely fabricated and manipulated with the trillions of dollars spent in stimulus. So if we understand this principle and why rates have calmed down and the MBS market has calmed down because the Fed has stepped in, isn't the same holding true in the stock market? I mean, the stimulus is acting as the Fed in the MBS market and just injecting trillions of dollars of support. It's almost like this gigantic Like they're pushing up the stock market. So when that gigantic push and support is gone, I mean, isn't there going to be some pretty big ramifications to that, or is it just going to continue to hold steady?
So, right, when all you have is a hammer, everything looks like a nail is the old saying, right?
Right.
So the Fed, they have been injecting this stimulus. And listen, of course, they want to do what they know how to do. And the stock market's response to this, this steroid, I mean, it looks like it's almost like methamphetamine now, right? So the stock market's response is, oh, the Fed's got the punch bowl out, we should go up. That's just been the playbook, and it's been a good playbook for results. The thing is, though, is that when you are looking at the current state of the stock market, it's not like it was in the past. Yes, the Fed's injected all this, and without it, the stock market would be in a completely different place. So it's being kind of propped up by all this liquidity. And the Fed wants to do that because that tends to be something that the Fed's gone to in the past. Ben Bernanke was very public about it. First Fed chair that was so public about it said, look, we want to create this wealth effect. During the Great Recession, he said, if we can give people nowhere else to put their money, let's punish everybody. Let's destroy retirees. Let's totally screw them over.
Jeez.
And let's make interest rates to where you can't get a return and you're forced to put in the stock market. Then what we'll do is we'll cause asset prices to rise, and those fortunate ones who have the assets to be in the stock market will see this enormous creation of wealth. You'll feel good and you'll start spending because you feel good.
Right.
Let's face it. We've all been in the position in the past where you watch your mutual funds, you watch your statements come in from your brokers, and they're down, down, down. You're not in the mood to spend. But when you see those ballooning, you feel, oh, man, I could spend. And the Fed knows this. And that's what the Fed's trying to do. But there is a negative effect to this, and there is only so far it can go.
Yeah, when's that euphoria, wear off?
It potentially is starting to show some signs of it now, at least in the short term, because remember when the Fed came out with their statement yesterday, even their numbers are showing that we're going to be in low growth GDP. We're going to have low inflation. We're going to have zero bound interest rates for the foreseeable future, almost unanimous. We never get that. So this is a really interesting time where the market is it's almost like waking up after a night of partying for the marketplace and say, well, wait, I know we were kind of like thinking that this is all gung-ho, but maybe it's not all perfect. Maybe there's a little bit of reason here. And unfortunately, right, what happens is that you're going to get a lot of people that were late to the party that got in, and they oftentimes are the ones that get left holding the bag as all that money starts to exit. So we just have to be cautious here. Look, nobody knows what tomorrow holds for this. Nobody knows what the news is going to be. But we have been, first of all, I will be totally transparent and admit I was wrong because I thought the stock market would come back in before this. I was completely wrong because it went higher. But now it is starting to show some signs of fatigue, interestingly enough, almost to the exact decimal of the 1929 retracement before that big number came down. So.
And that's, I don't know, in closing, I'll kind of throw to you. I don't know if I'm personally holding the right position, but I don't understand what's happening. Typically cause and effect. I can add that up. That makes sense to me. But because none of this is making sense to me, I've got money parked on the sideline, and I don't have your brain, Barry, to figure out how to take advantage of the opportunities that are here. I know there are some, but I am not smart enough to know. So I'm kind of on the sideline because it doesn't make sense to me. I'm kind of waiting this stuff out. Is that an ignorant stance? Like, if you're coaching me up, what would you say?
First of all, brother, you're super smart, okay? And as I said before, I'm far from getting it right all the time. I just told you I was wrong because I thought the stock market, 300 points ago on the S&P was overdone, okay? I admit I was wrong. But I think it's wise to have a cautious approach, right? And I think you need to be also paying attention and nimble, because if it starts to accelerate, you want to be nimble enough. Now, again, I showed you that 200-day moving average. We could see some buying come in there. We could see a little bit of a run. But, Mark Twain said that history doesn't always repeat itself, but it does tend to rhyme. Okay, so.
Yeah, I love that statement.
This appears like a good rhyme to me. Again, there's no guarantees here, and I could absolutely be wrong, but I will tell you this. Back, about 12 years ago, 13 years ago, when the market didn't make sense. I'm sorry, 14 years ago. Let's go back to 2006. The market didn't make sense to me. It really did not in the housing area. And when it stopped, you just said words that reminded me of that. It's just like, it doesn't make sense.
Yeah.
When it stopped making sense to me in the housing market, created things like CMPS, actually sold Mortgage Market Guide. These are the types of things that caused me concern because I couldn't figure it out anymore. I couldn't justify it. And I do agree with you, and I have the same feeling as you with what's going on right now in the stock market. Once again, John Maynard Keynes could remain irrational longer than we can remain solvent.
Yeah.
But I just, at some point in time, earnings matter. At some point in time, PE ratios matter. And I don't see those coming back to justify the levels that we are anytime in the very near future. But I could be wrong.
Well, buddy, once again, what you said makes sense to me, and I appreciate that. Guys, we have Barry, and we're lucky enough to have Barry on maybe every other week. But you get this type of gold every day if you're an MBS Highway subscriber. If you're originators, I know you know about it. If you're still stubborn and you haven't subscribed, you need to. Just stop it. That's ridiculous. Realtors, again, everything he said makes sense. This is reasonable to me hearing what Barry's saying in this conversation. What I'm seeing on the news, like I said earlier, doesn't. So if you want to, be a realtor and have a subscription, again, MBS Highway, we'll put a link down below. I would absolutely subscribe to Barry right now. If you're a consumer, man, this is gold. This will help you kind of make sense of the craziness that's happening right now. And we'll put all that down below. You can ask Barry questions. I'm sure he's nice enough. He'll answer them. Maybe don't ask specific stock questions, but ask other questions. Barry, again, man, thank you so much. This has been so helpful for me personally, and I'm sure our Resource Nation will love it as well.
Oh, bro, you and RC, you do such a great job. I am honored. It's a privilege to be on with you, man. Love you guys.
Appreciate it. We'll see you guys next time.
Thanks, man.